Following the last episode where we compared the effectiveness of the efficiency ratio and price density to inform asset noise filtering, this time I do similar but for a technique called instantaneous noise filtering. Find out which will come out on top after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Instantaneous noise filtering has advantages over the more simple asset filtering technique. But does it enable as big an impact on system performance, and is it better to use the efficiency ratio or price density to inform this? Let's take a closer look. So far in this series, we've looked at how noise-based strategy improvement methods can be undertaken using the efficiency ratio as a measure of noise, and then in the previous episode we started to compare this with similar results but using price density, and we did this for the technique called asset filtering. This time we continue on the same theme but turn our attention to instantaneous noise filtering and take a look at whether the efficiency ratio or price density methods will come out on top. Before we start, let's just do a very quick recap about what the differences are between asset filtering and instantaneous filtering. With asset filtering, we make an upfront decision about which assets we will choose to trade based on those that have characteristics around noise that are suited to the trading strategy that we're using. And if you remember from previous episodes, we talked about the principle that very often mean reversion strategies are more suited to high noise assets and trend following strategies tend to be more suited to the low noise assets. So here we might choose to trade these 4 out of 8, and the other 4 we will not trade with a particular strategy. But instantaneous filtering is different. Here we are prepared to trade a much wider range of assets, but only when the conditions in those assets are suitable in terms of noise for the trading strategy we're using. And then when the noise characteristics are not suitable, the strategy will not allow those assets to be traded. So to keep things completely consistent with the previous research, we're going to use exactly the same mean reversion strategy, but this time we're going to look directly at whether the efficiency ratio or price density better informs our instantaneous noise filtering technique. So here's the baseline that we've now seen many times, and this was obtained by trading the mean reversion strategy over a 10-year period using all 28 currency pairs and trading those whenever we got a signal. And to remind ourselves of the improvements that we saw previously when using the efficiency ratio, we took the equity curve from this on the left to this on the right. And so by implementing that instantaneous noise filtering technique had the effect of reducing the number of trades to just over 7,000. But look at the improvement in the performance metric. And in this particular case, it's the compound annual growth rate over the mean drawdown. And this has gone from 0.25 to 1.47. So a significant improvement. So these are the results that we've seen previously. Now we turn our attention to the same technique using price density. So if we just move the efficiency ratio chart over to the left here, these are the results that we get for price density informing that instantaneous filtering. Now note here that whenever you perform this type of filtering, you have to decide on a threshold noise level, and anything that's noisier than that threshold can be traded, anything that's less noisy than the threshold can't. And I've specifically chosen a threshold for price density that gives me a very similar number of trades to when we use the efficiency ratio. And the reason I've done it that way is so that we can have a fair comparison between these two different methods. Because if either one or the other of these techniques was filtering out far more trades than the other, it wouldn't be a valid comparison. So look at the difference in the performance metric here. It appears, on the face of it again, that it's the efficiency ratio that is informing this particular technique more accurately. And the performance metric is almost 3 times larger. And of course we can also see that visually from the equity chart itself. And I believe this to be a valid comparison because of the fact that each of these techniques has filtered out an almost identical number of trades. So what are the conclusions that we can draw from this research study? Well, firstly, in all 3 different techniques, we've seen that these have had a dramatic effect on the performance of the trading strategy and therefore the edge. And secondly, in our comparison of the 2 measures of noise, the efficiency ratio and the price density, certainly in the results of this study, the efficiency ratio appeared to be more effective when used with this particular mean reversion strategy. Now, bear in mind that that might not be always the case for different strategies. And this, of course, is where the hard work starts for you and your strategy. You'll need to incorporate these techniques into your trading strategies, backtest those to see how effective each of these measures are, and make your own decision about whether price density or the efficiency ratio performs better for your own strategies. So that concludes this brief research study, but we haven't finished with market noise yet. In the next episode, I'm going to look at how noise varies compared with volatility. We're going to look at how these are different, but also look at what they have in common. Because understanding this will inform when you should be using one particular characteristic and when you should be using the other in terms of your decision making in your trading systems. Now, if you've got value from this series so far, please do remember to give me a thumbs up for all of the videos that you watch, and also remember to share them on the trading forums that you use and the social media sites. Now, if that next episode talking about the differences between noise and volatility is already available, then you'll see a link to it top right. But now until next time, trade wise, trade safe.